Hello, good morning, good afternoon, good evening, depending on where you are in the world. I'm Nicolas Véron at the Peterson Institute, and it's my delight to open the session of our financial statement series with Isabel Schnabel and Maurice Obstfeld to discuss the challenges of the era of low interest rates and low inflation. This is going to be a bit more macro than usual in this series, as the jargon has it in economics, but we will certainly discuss related issues that are directly relevant to the financial system and financial services, but also looking at the broader context. And there couldn't be a better way to do that than to exchange with Isabel and Maurice. Isabel Schnabel, of course, is a member of the executive board of the ECB, which she joined in February 2019. She studied in Mannheim in Germany, in Paris at the Sorbonne University, and indeed at University of California at Berkeley. She got her PhD in economics under supervision by Martin Hellwig, known to many in the audience, and also worked early in her career at Deutsche Bank, I think, in different locations, Dortmund, St. Petersburg, and Frankfurt. She worked at the Max Planck Institute in Bonn. In 2007, became professor of finance at Gutenberg University in Mainz. And in 2014, she joined the German Council of Economic Experts, which plays a big role in the German economic policymaking environment. In 2015, she joined University of Bonn as professor of financial economics. And of course, in 2019, the European Central Bank as a member of the executive board and especially in charge of economics as a chief economist. As responsible for market operations. My notes were lousy. I apologize for that. But she also finds a lot on economics. She has a long-standing experience in policy at the Deutsche Bundesbank, where she has been a member of the Scientific Advisory Board of the Research Data and Service Center, at the European Systemic Risk Board as a member of the Advisory Scientific Committee since 2015, and earlier with BaFin, the German Financial Supervisory Authority, member since 2008 of the Advisory Board, of which he was also chairperson, and member of the Administrative Council of BaFin. I'm not sure we will discuss BaFin a lot in this session, but that's another topic for further interaction, I'm sure. I have to disclose that Isabel and I have worked together in the past. I should rather say that I had the privilege of working with Isabel, and we were co-authors a couple of years ago on issues of Eurozone reform, and so I know that I can place the bar pretty high in terms of what to expect from this conversation. Maurice Obstfeld is, of course, a senior fellow at the Peterson Institute. I should mention that first, which he joined in February 2019. He's also a professor of economics at the University of California in Berkeley, and he joins us actually from there. So I'm particularly grateful to Maurice for waking up very early for this session. I feel bad about it, but lots of gratitude. Maurice is a titan of international economics, if I can put it that way. He studied at University of Pennsylvania and also MIT, where he received his PhD in 1979. He was also a visiting scholar at the Federal Reserve, was in the faculty of Columbia University, New York, University of Pennsylvania. Berkeley, he joined in 1989, and was also a visiting professor at Harvard in the late 80s, early 90s. He joined the White House under the Obama administration as a member of the Council of Economic Advisors as lead macroeconomist in June 2014. And in July 2015, Christine Lagarde, then the managing director of the International Monetary Fund, hired Maurice as chief economist, economic counselor, and director of the research department, which position he held for more than 3 years succeeding Olivier Blanchard, of course, also now at the Peterson Institute. So there are at least two common points between Isabel and Maury. They both have worked with Christine Lagarde, and they are both associated with Berkeley, but there is much more to it. And on that, Isabel, over to you.
Thank you very much, Nicolas, for your kind introductory words and for the invitation. So let me try to share my screen. So I hope you can see it. All right, so perfect. So let me first say it's a pleasure being here, and I very much look forward to our joint discussion with Maury. So thank you, Maury, for getting up so early for this event. It's really a great pleasure. I would like to use my short introductory remarks to briefly explain some features of the ECB's new monetary policy strategy, which we published last week. And we have made a number of important changes to our strategy, but in the interest of time, I won't review all of them here today, but I would rather invite you to read the very comprehensive material that you find on the ECB's website. And instead, I would like to focus especially on the changes to our strategy that go to the heart of the financial statement series that Nicolas hosts here at the Peterson Institute, namely on the role of financial stability for our monetary policy, while touching on the other aspects only briefly. And please also note that a more comprehensive version of this speech covering all other aspects of the review is available on our website, also including a slightly more comprehensive set of slides. The starting point of our review was a stock-taking exercise of two distinct but related developments that have severely challenged the conduct of monetary policy over the past decade. One was a gradual and persistent decline in the real equilibrium interest rate, which you can see on my first slide. Slow-moving structural factors such as an aging society and lower trend productivity growth have led to an abundant supply of savings facing a muted investment demand, putting downward pressure on interest rates across advanced economies. The second and equally widespread development was a protracted period of disinflation. And you can see this on my next slide. So in spite of unprecedented monetary policy accommodation, inflation in the euro area has averaged just 1.2% since the global financial crisis, which was well below the aim adopted by the Governing Council in 2003 of below but close to 2%. And as a result, central banks worldwide, and of course also the ECB, have been forced to find new instruments that could provide additional policy accommodation. The ECB, for its part, has introduced a wide range of such novel monetary policy tools, including negative interest rates, forward guidance, longer-term refinancing operations, and of course, asset purchases. In our review, we judged that the current macroeconomic landscape implied a higher probability of hitting the lower bound also in the future. And considering this evidence, we made three important changes to our framework. So first, we adjusted our definition of price stability by replacing our previous version of below but close to 2% with the clear 2% inflation target over the medium term. We judged that there was a risk that our previous inflation aim could be considered to be asymmetric, potentially implying that 2% was seen as a ceiling rather than a target. And the left-hand chart of my next slide shows that such perceptions actually matter. Staff analysis shows that over time, an asymmetric response could give rise to meaningfully lower inflation and growth outcomes, and thereby entrench expectations of low inflation. The right-hand side chart shows that persistent inflation outcomes below our aim may have led professional forecasters and financial market participants to gradually expect lower inflation also in the future. A clear and symmetric 2% inflation target over the medium term will remove any ambiguities and provide a more solid anchor for long-term inflation expectations. I should also mention that we decided to recommend a roadmap to include owner-occupied housing in our inflation index, which so far had not fully reflected housing costs. Second, our strategy recognizes the challenges of protecting price stability in the vicinity of the lower bound and sets out the requirements for effective macroeconomic stabilization. Most importantly, because of the lower bound, maintaining symmetry implies that there is a need to take the implications of the effective lower bound explicitly into account when deciding on our policy stance. Otherwise, disinflationary shocks not being fully offset, thereby potentially becoming a more persistent drag on growth, prices, and wages over time. And in view of these risks, we clarified that when the economy is close to the lower bound, monetary policy needs to respond especially forcefully or persistently to avoid that negative deviations from the inflation target become entrenched in expectations. And we also clarified that this may imply a transitory period in which inflation is moderately above 2%. In practice, inflation overshoots may be the result of the Governing Council exercising patience in adjusting its policy stance when faced with an improving outlook. Moreover, we decided that the range of policy instruments used over the last few years will remain part of our toolkit in the future, meaning they should no longer be regarded as unconventional. And there's compelling empirical evidence that these instruments have contributed, both individually and collectively, to easing the relevant financing conditions for firms and households. The review also stresses the crucial role of countercyclical discretionary fiscal policy in crisis times and in the proximity of the lower bound in order to complement and reinforce monetary policy. And third, our new strategy emphasizes that some areas merit particular attention in the pursuit of price stability over the medium term. And one is financial stability, which can pose severe risks to price stability, as shown vividly by the global financial crisis. Another is climate change, which is increasingly threatening price stability through both physical and transition risks. So our revised framework explicitly recognizes the potential risks that come with our policy measures, in particular with the more forceful or persistent policy response close to the lower bound. As illustrated on this slide, we revised our analytical framework such that in addition to our economic analysis, our price stability assessment will now be based on a monetary and financial analysis that recognizes that financial stability is a precondition for price stability, and that also recognizes that macroprudential policies do not yet offer effective protection. The focus of this analysis will be on the monetary policy transmission mechanism, in particular via the bank lending, risk-taking, and asset pricing channels, and will systematically evaluate the longer-term buildup of financial vulnerabilities and imbalances and their possible implications for future tail risks to output and inflation. Assigning a more prominent role to financial stability does not mean that the Governing Council will conduct policies of leaning against the wind, whereby monetary policy is systematically tightened when systemic risk builds up, or of cleaning, whereby monetary policy is systematically loosened when systemic risk materializes. Macroprudential policies will remain the first line of defense. It rather means that we will follow a flexible approach in accounting for financial stability, which is consistent with the medium-term orientation of our strategy. From the beginning, the medium-term orientation has afforded the Governing Council the required flexibility to tailor policy responses to the size, persistence, and type of shock it is facing. So, for example, supply-side shocks often require a lengthening of the medium-term horizon in order to mitigate negative effects on real economic activity and employment. And the medium-term orientation also allows the ECB to take account of financial stability considerations. The use of such flexibility will be subject to a careful proportionality assessment, which has been enshrined in our new strategy. And this assessment comprises a systematic analysis of the evolving balance of the benefits and costs of our actions, taking account of their effectiveness and side effects, as well as risks of a destabilization of inflation expectations. And my next slide shows why such an assessment is particularly important at the lower bound. ECB staff analysis suggests that at the lower bound, there is a risk that the marginal benefit of an additional unit of policy accommodation may diminish, not only in the euro area, but across advanced economies. The impact of monetary policy is also likely to be state contingent, with policy being most effective in deep recessions. At the same time, the potential costs in terms of financial stability or income and wealth inequality may increase. The outcome of such proportionality assessment can influence the choice and the design of our measures, as well as the intensity with which they are used. For example, the exclusion of household mortgages from the loans eligible under our targeted longer-term refinancing operations aims to avoid fueling house prices. Similarly, the two-tier system of reserves helps to protect the bank lending channel by mitigating the impact of negative interest rates on banks' profitability. Finally,
sorry to interrupt, yes. But I'm always a bit of the acronym police in this series. FCI is the Financial Conditions Index, right?
Oh, yes, exactly. I'm sorry for that. I'm very sorry. Yes, you're perfectly right. And finally, our review will also give greater prominence to structural trends and the implications for inflation, potential output, and the equilibrium real rate of interest, with a particular focus on climate change and the economy's transition to carbon neutrality. And in fact, there's also linked to financial stability there. We acknowledge the growing evidence towards climate change related risks materializing faster than previously expected. In fact, the physical damages of climate change are already clearly visible, as shown on this slide. And while governments and parliaments clearly have the primary responsibility to act on climate change, we recognize the need to further incorporate climate considerations into our policy framework. And we have therefore committed to an ambitious climate-related action plan that will culminate in broad changes to our monetary policy implementation framework, including, among other things, disclosure requirements for eligibility as collateral and for asset purchases, modifications to the valuation and risk control frameworks based on climate change-related risks, and adjustments to the framework guiding the allocation of corporate bond purchases. And you can see the importance of the last point on my final slide. So only by taking climate-related factors into account, we will be able to reduce the emission bias induced by the current market neutrality principle in our corporate bond portfolio. So I would like to invite you to read the full version of the speech and, of course, much more importantly, the official documents on the outcome of the strategy review. And I now look very much forward to Maurice's comments and to the subsequent discussion. So thank you very much.
Thanks so much, Isabel. And indeed, I think your speech is already on the European Central Bank's website and will be soon on the Peterson Institute's website and has additional text compared to what you just delivered. But you gave us the essence of it. And with that, Maury?
Thank you, Nicolas. It's a great pleasure to be here with Isabel and Nicolas, and to react a little bit to the report of the ECB and to Isabel's presentation. The starting point for all of this, and this is also true of the Fed's recent review, is really the title of this session, that the natural real interest rate is likely to remain low for long. And to my mind, this implies that we will have more frequent bouts of time at the effective lower bound, which creates an environment of asymmetric risks. And I think it's important to look at these monetary policy frameworks in that context. And I think one way to understand what a huge sea change this report is compared to the previous doctrine of the ECB, which was actually formulated in the last review in 2003, is to look at some of the main contrasts. So I want to emphasize three main contrasts. I'm going to leave out climate, which is of course a major contrast, but that would require a whole hour or two extra to really talk about adequately, and maybe Nicolas will want to schedule something on that at a future date. But my three main takeaways are one, the 2% target, a target, not a ceiling, as in 2003. The role of financial stability, basically absent in 2003 as a consideration, and a very different discussion of fiscal and structural policy, which Isabel did not mention, and which I haven't seen highlighted in the press, but I think is incredibly important and also is related to financial stability. As Isabel discussed, this is not a regime of average inflation targeting like the Fed's. It really removes the ceiling and the potential deflationary bias that was there before in the language of the ECB about price stability. There is a question of how this will operate in an environment of asymmetric risks. The report talks about particularly forceful reactions near the zero lower bound, the new tools which have been developed in past years. These include negative interest rates not used so far in the United States. But it's notable that even the 2003 review cited the zero lower bound as a threat. And at that time, this was a sort of vague risk on the horizon inspired by Japan's experience and the slow recovery of employment from the dot-com crash. But now this has been our life, our everyday experience since the global financial crisis. One question is whether we will ultimately need a rise in inflation targets. And the report presents what has been done as a slight rise in the inflation target. I think it goes far beyond that, but maybe we're going to need even more down the road. Financial stability threats are the second big issue, which are likely to be even more prominent as we remain near the zero lower bound, due to reach for yield, due to zombification. There's a whole range of issues, and this presents a trade-off in some situations between the price stability goal and the financial stability goal. This may not be a long-term trade-off, but it is certainly going to be a medium-term trade-off. So you need a set of very powerful macroprudential tools to deal with this, and it's always a question whether what we have is enough. The report points to completing the banking union, completing the capital markets union, and this, of course, will require more aggressive completion of fiscal union, at least to break the doom loop that was so evident during the Eurozone crisis. Finally, the fiscal and structural issues. This is a very striking part of the report, so I bring it up in a little bit of detail. The 2003 review is basically beating the drum for the Stability and Growth Pact. Obey the pact and everything will be fine. And that will take care of fiscal, and then monetary policy can do its job. And now, in light of our asymmetric experience, the report basically says, yes, we need automatic stabilizers. Those should be allowed to operate. But near the effective lower bound, we need more. We need counter-cyclical fiscal policy. This is kind of an obvious point, but it's not a point that some on the Governing Council have emphasized. There is a call here to build in buffers in good times so that counter-cyclical fiscal policy can work without creating the risk of debt crisis. But buffers never seem to be built up in good times, at least consistently by most countries. And so even with very low interest rates, if growth is lower, there is a risk of fiscal problems. And of course, without severing the doom loop, financial stability problems are intricately mixed with those. One suggestion in the report about structural policy is that it may raise the natural rate of interest. And again, this is a very different discussion about structural policy than was in the 2003 report. But I worry that the natural rate of interest, the natural real rate, is really a global phenomenon. It will depend in part on the growth prospects in emerging and developing countries. And to my mind, those growth prospects are not looking very good in light of the current vaccination experience, in light of the very real possibilities of scarring, in light of the very real possibilities of further debt problems down the road for those countries. So all in all, I think this is a important response to changed conditions. You know, my question would be whether this really goes far enough to confront the challenges that we will face in coming years.
Thanks so much, Maurice. This was superb, and I cannot help asking Isabel whether how she reacts to that. Are you doing too little, especially on the inflation target, but also on other dimensions?
So thank you very much, Maurice, for these very thoughtful considerations. So let me try to respond to some of them. So on the target, actually, we ourselves did not see the 2% as a target. But it's actually interesting that you obviously did see it as a target, and many people in the markets obviously did see it as a target, as a ceiling. Sorry, the ceiling. We saw it as a target, and we had already. So Mario Draghi introduced that actually already in 2019, of course, with the consent of the Governing Council, that we saw as our target as being symmetric. But given the formulation that we had, that obviously was not very credible. And so I think this was extremely important that we changed the wording here. And by the way, more generally, I think, and this also refers to all these things that you mentioned on fiscal, I think what makes this review very strong is that we had this unanimous consent on all parts of the review. And this, I think, gives our strategy a great degree of credibility, because in the end, of course, what matters is not what we write in our strategy, but what we then actually do going forward. And so I think it's very good to start from something that is agreed upon by everybody. You're right that we are not doing average inflation targeting. Of course, we discussed the potential rise in inflation targets, but honestly, in our situation, this would not have been a very credible approach, given that we have failed to reach our targets over the past 10 or so years. A higher inflation target would not have been credible. So you raised a number of very interesting points on financial stability, and I share all of them. You're very right in pointing to the trade-off that arises between, or that potentially arises in some situations between financial stability and price stability. And you also mentioned very rightly that this is very much a question of horizon. So because it may be that there is a trade-off in the shorter term, even though in the longer term, let's say a crisis is prevented, and then actually over that longer horizon, the trade-off is not even there. Macroprudential policies, as also mentioned in my remarks, certainly are the first line of defense. But they have, at the moment, they have many weaknesses. And I mean, you were talking about the buffers in fiscal policy, but of course, we can also discuss the buffers in macroprudential policy. And there we had the same, that actually the buildup of buffers was not sufficient. So this is a very general problem. And of course, I'm also grateful that you mentioned a banking union, capital markets union, and also a fiscal union, which of course, I mean, for a single monetary policy, the current architecture of the euro area is indeed suboptimal. So you rightly pointed to the, I would actually say, revolution regarding the views on fiscal and structural policies. And you're also right that this was not picked up a lot in the press, probably because it was only contained in the longer overview document and not in the 2-pager, which is our monetary policy statement. So there was actually unanimous support of this view that a more active counter-cyclical discretionary fiscal policy is needed near the effective lower bounds. And so I think this is extremely important. And in fact, I mean, we have seen in the past that fiscal policy under-delivered quite substantially. In this pandemic, we've seen that fiscal policy has complemented monetary policy in the euro area very nicely. But of course, we have to see what's going to happen going forward. And I always stress that the worst thing that could happen is that either monetary or fiscal policy tightened prematurely. And then your final point, of course, is probably the most interesting and at the same time most relevant one, which is the one on the let's say the global dimension of R star. And I think this is actually a very interesting area also for research. I share your concern about the emerging markets. I mean, in general, we always said there are so many risks of divergences due to the pandemic, and this divergence between the advanced and the developing economies is, of course, a very big one. I mean, we still don't know what is going to happen. I mean, of course, there are also people who argue that this push towards digitalization actually will more generally lead to a rise in R star, actually. And this, the question is whether the developing countries could also benefit from that. But overall, I share your concerns about potential scarring and the debt problems that may arise down the road. So
and R star here would be the equilibrium interest rate.
Exactly. Sorry.
Maury, on Isabel's last point on the technological developments contributing to an increase in R star, including possibly in emerging markets, how do you view that, and how does it square with your perspective?
Well, you know, as you know, Nicolas, there's a great debate over whether we have, you know, reached the frontier of great technological developments or not, and I tend to think that we have not. But you know, short of some technological revolution that really raises global investment sharply. I think the demographic trends weighing on R star, you know, the sort of legacy now of two big recessions are just too great to be overcome in the short term. And you know, one can say, well, maybe something will happen technologically that will raise the natural rate, but significantly. But we haven't seen it, and it keeps declining. So I don't think we can necessarily pin our hopes on that. It would be great if it happens.
Do you measure, or is there an assessment of R star for emerging markets or at a global level?
Well, you know, I think the interesting point is that you know, historically, real interest rates in emerging markets have been higher. It's not clear how much of this is due to risk considerations, but they have been higher, and growth has been higher. If you actually look at growth data from the you know, global growth data starting in 2000 and up until really now, you know, the growth rate in emerging markets breaks upward, and the growth rate in advanced economies breaks downward. So I think any estimate of R star for emerging markets would show them to be higher. And the question in my mind is whether that will continue in terms of growth. But another question central to the, you know, I think the topic of this seminar series is the nature of financial intermediation from rich country capital markets to poor country capital markets. If R star is higher in those poor markets, but the capital flow mechanism is impeded, for example, by debt crisis factors, then the feedback into advanced country rates may not be that great. So that's I think an issue to worry about going forward. How efficiently can the world capital market transfer resources to emerging markets?
There's a slightly related question from Mark Vail in the Q&A, which maybe I'll start with you, Maury. The presentation mentioned aging populations and declining productivity as sources of disinflation and lower interest rates, and that, of course, in the environment of the Eurozone. What role do you believe strictures on fiscal policy and public investment have played in terms of driving low inflation, low interest rates?
I think they've played some role, and clearly public investment in the Eurozone has fallen compared to past decades. It's true in the US also. Up until recently, with the large fiscal support we've seen in the COVID pandemic, there has been an austerity bias in fiscal policy generally as well. So I think those have been, to some degree, contributing factors. Certainly looking at the slow US recovery from the GFC, the Euro crisis, fiscal was a factor. From that perspective, if there's a big infrastructure push in the US, that could be positive for global R-star. Remains to be seen what will actually happen.
Isabel, on this question of the different contributors to the disinflation and low interest rate, do you want to add anything?
So let me just say that I agree with Maurice's view that it's very likely that fiscal policy has played a role. I think an interesting example is actually Germany, where you've seen that there has been a lot of fiscal discipline, let's say, with the debt break and so on, but at the same time, public investment has been extremely low, and it's a more general phenomenon in the euro area. And I think it's pretty obvious that in the previous crisis, the fiscal policy played a not very beneficial role. And the hope now is that, of course, with the Next Generation EU program, that these funds are going to be used in an efficient way, which then, of course, could help lifting the euro area out of this low inflation, low interest rate, low growth world. That would be the hope, and therefore I think it's very good that these funds are focused on the green transition, on the digital transition, so potentially growth reinforcing areas. But let's see how the money is used in the end. But I think this is the hope, of course, of this whole big package.
But actually, I wanted to ask you this about Next Generation EU. And it has been presented by some as a complete game changer, because, to use the words of German Finance Minister Olaf Scholz, maybe it's not fiscal union, but it's a giant step towards fiscal union. So how much does it affect the whole framework in which you operate, in terms of the fiscal framework, but also in terms of related financial stability considerations, including the doom loop?
So for now, I would say, of course, that this package is extremely important and useful. We know that many countries in the euro area had a relatively strong national fiscal response initially. But now, of course, some countries are starting to discuss rolling that back. And but at the same time, then the next generation EU funds kick in, which has a very important stabilizing effect. Of course, we should be aware that this is a one-off. So so far, there's no agreement whatsoever that this is going to be a permanent fiscal facility. And whether there will ever be steps in that direction, I think, will depend very much on the question whether this whole package is going to be seen as a success or not. And this will very much depend on the growth performance of the euro area going forward.
Even leaving aside Next Generation EU, there are 2 points, related points maybe, that Maury has mentioned in terms of the post-COVID environment and the risks that lurk in that environment. One is the general possibility of zombification and having a complete misallocation, basically, of capital and credit particularly in the non-financial corporate sector. And the other is the possibility of the infamous doom loop, the vicious circle between banks and sovereigns, assuming, as you just suggested, that next generation EU is still a bit of a question mark. So how does that interfere with the considerations of the review? And maybe even leaving aside the review, how do you look at the risk right now? And how do you look at the outlook and landscape right now, given all the good news that have come into the past 6 months in terms of vaccination, better growth prospects, etc.? Can you give us a bit of a snapshot, not going into all dimensions, but basically where you stand on the range of views?
All right. So, I mean, on the macroeconomic outlook, of course, we have now, let's say, surpassed the turning point, and we are seeing a very strong recovery, which is related in particular to the reopening of the economy. Of course, now there is a new risk coming from the Delta variant and other variants, and we still have no idea how this is going to play out. Of course, also in the euro area, we have seen some countries where the infection numbers have spiked quite dramatically, and it's still too early to tell what this will mean for the economic development. My impression is that the willingness to go into another lockdown is relatively small, that this is politically relatively complicated. In particular, if it remains true that the fatality rate remains relatively low due to the vaccination, but this is something that has to be seen. I mean, on the inflation side, of course, we are seeing a lot of volatility at the moment. I mean, there is an inflation. I mean, is of course moving up, not as much as in the US, but it's also moving up. And a lot of that is due to temporary effects, in particular base effects, and so on. And according to our projections, we still think that in the medium term, the inflation outlook is going to be subdued. However, it's also clear that there's a lot of uncertainty about the inflation outlook, and of course, it's the same discussion as in the US, whether some of the one-off effects that we're seeing may actually be more permanent and may lead to second-round effects. At the moment, I mean, if we look, for example, at wages, we don't see any of that at the moment, but we have to see what's going to happen going forward. But I would say, actually, I would not even call that kind of upside risks to inflation, but I would call it upside chances to inflation, given that we have been below our aim for so long.
Maury, of course, this is a big debate of the moment. So where do you stand on the inflation outlook, both in the US and also for the Eurozone, if you want to comment on it?
Well, I agree with Isabel totally that there is a upside chance. I think the chance is higher in the US than in the Eurozone. I think with each passing month, the data get a little more worrisome. My base case is still that this is going to be temporary, but we are seeing sort of a broader range of sectors with price pressures in the U.S. One measure that people look at, which in the past has been a good predictor of inflation, is the median CPI measure that is calculated by the Cleveland Fed, which
CPI being, of course, the consumer price index.
The consumer price index. There's also a median PCE, but let me talk about the median CPI, and that is much. I don't want to get into the details, but it's much smoother than even the core CPI measure, and it's risen over past months from 2% to 2.1%. The latest reading is 2.2%. So that's creeping up. It's not it's sort of
it's not galloping,
flashing yellow, but not flashing red. But it's not something I think we can dismiss. Not necessarily my base case. One Isabel's comment about upside chances and not risks was very interesting to me, because it raises a question that was in my mind, and that is how the ECB views the concept of a planned overshoot of inflation. The press release from the ECB is very clear on saying that upward and low, that deviations above and below 2% are equally undesirable. But that's not really, that doesn't condition on situation. That's unconditionally. And so my question is, conditionally, for example, given that we've had very, very low inflation for a long time in the Eurozone, might a planned overshoot of 2% be admissible? And how do you on the board think about that?
So maybe I can bundle, I come back to you, Isabel, but I will bundle Maurice's last query with a number of questions we have in the Q&A and the chat on the review. And I think, there's some skepticism out there, or at least people wanting to be convinced that the review changes the landscape, or how it does. So Aurel Schubert, Julian Callow, Lucio Pench, in different formulations, have all asked, how much does it change your reaction function, right? I mean, if you had this review 5 years ago, would your actions have been different? Would the ECB action have been different? Julian Callow asked how much of a revision of the reaction function for monetary policy will result from the strategy review compared with what we have experienced during the last 5 years. Lucio Pench asked which innovation, if any, does the review of the monetary policy framework imply? And similarly from Aurel. Philip Martin and Joachim Fels ask a slightly different but related question. You kind of said we're not raising our target because we wouldn't be credible, because we didn't reach our target anyway. But doesn't that translate to what you say about the target? I mean, you said, we're going from below but close to 2% to a symmetrical, but you're not reaching it anyway. So how different is that? And there's an additional question from Lucio Pench on the Stability and Growth Pact, where he asks, what you described as the lower bound in the vicinity of the lower bound, how does that square with the rules of the Stability and Growth Pact? Do you simply mean more frequent recourse to the general escape clause, to a waiver from the fiscal rules of the European fiscal framework? So bundling all this, over to you.
So that's a very broad set of questions. I hope I remember them all. So let me first say I find it funny that you're always kind of explaining all the abbreviations, because actually Christine Lagarde is always pushing us to avoid abbreviations, and so I was reminded of that. So I think that's actually very nice. Well, I think all of those questions are a bit related to Maurice's question, which of course is a crucial one. As you, Maurice, already said in your introductory remarks, we don't have an average inflation targeting regime, which implies that we have not committed to an intentional overshooting. In the strategy document is that our policies may imply a moderate and or may imply inflation being moderately and in a transitory fashion above our inflation target, which is different from an intentional overshoot. But let me explain what this actually means. I think the main point is, and this is also, I would say, a lesson from the past, maybe not so much from the past 5 years, but before, is that that everybody in the Governing Council agrees that we have to avoid a premature tightening of monetary policy. So what must not happen is that we look, let's say, at our projections or at market inflation expectations or whatever indicators we have, and we see at the end of the projection horizon, we see there is a 2. So this would not immediately trigger an interest rate hike, but rather we would commit to being much more patient than that. And we would have to have high confidence in actually seeing these 2% being there in a more durable fashion. And because otherwise, if of course one hikes immediately when one sees a 2 somewhere, then it's not surprising that the 2 is never reached. And I think this is basically the essence of that sentence in the strategy review. And I guess it also answers the question on the reaction function. So on the instruments, I mean, we looked at our set of instruments very carefully, and we came to the conclusion that that these instruments were actually quite effective, and in particular, the combination of different instruments was quite effective. I mean, one shouldn't forget that the euro area was subject to a series of disinflationary shocks. So that was actually, it was not an easy time to also to achieve the inflation aim. I mean, there was fiscal policy, which was partly working in the opposite direction. Maybe the decision to shift to unconventional tools came a bit too late. I mean, looking forward, I think we are in a better situation. I mean, we just discussed the more recent inflation dynamics, which actually move in a much better direction. So I'm actually much more optimistic that we will be able to reach our inflation aim maybe sooner than some people expect at the moment. We said that we would be willing to also think about new tools, and of course I know why Philippe asked this question, because he's written this interesting paper on helicopter money, and I mean, so we are generally open to look at new tools. At the moment, we don't consider that to be necessary, but we're always open. Just very briefly on the Stability and Growth Pact, of course, that is not up to us to decide. But the position of the ECB has always been that some degree of flexibility is needed, and that the current framework in several respects may not be optimal, and that one may consider on this occasion of the pandemic to revise the framework.
Maury, on the Stability and Growth Pact, is there anything you want to share? That's very Eurocentric, of course, but I know you observe that.
No, you know, I sort of shared some of the initial excitement about next generation EU, and you know, I think it's a legitimate question whether without more fiscal union, the you know, the ECB's recommendation of more aggressive countercyclical policy near the zero lower bound can actually be implemented. And you know, I think one sort of general, sort of very overarching implication of the low interest rate environment, to the extent that we remain in it, is the need for, you know, much more intimate coordination of monetary financial stability and fiscal policy. And there are just many linkages, and you know, the idea of just, you know, assigning instruments to different you know, sort of independent actors and getting it right is just not going to work. And so this is a, you know, this is a challenge for central banks everywhere. It's not just the ECB, but within the particular setting of Europe, where even there's even a division of financial stability responsibilities between member states and the center, and the ECB and other agencies. It's a particular challenge. So I think this is an area where just a strategy review by the ECB is useful and important, but not enough. There needs to be a larger economic policy strategy review within the euro area.
And of course, that connects with the issue of ECB independence and legal constraints on its action.
Absolutely.
Isabel, you mentioned the proportionality assessment pledge at the beginning, and I guess that's at least partly a response to the ruling of the German Constitutional Court in May last year on your crisis-related actions. Can you tell us more about that and about the risks that this might constrain the ECB just too much, that there might be situations where you cannot do what you should do because of all this web of legal entanglements?
So let me say first that that I wouldn't agree with what you said, that this is merely a response to what the German Constitutional Court did. Because, I mean, of course, the proportionality principle is a very fundamental principle in the European treaties, and even though we may not have used the word as often before the ruling, the principle was always very much embedded in our policies. And
so my suggestion was only on the semantics, I guess.
It's more on the semantic side, I think. So I think it's extremely important that whatever decision we take on a monetary policy action, that we do a careful assessment of the benefits and the potential costs, and not only for one particular instrument, but also when asking ourselves which instrument to choose. So whether to, I don't know, lower the deposit facility rate even further or increase asset purchases. And this requires a very careful analysis, both of the benefits and the effectiveness, and also of the side effects and the potential costs. I mean, of course, in the end, that also imposes constraints, but this is something that is relatively hard to avoid. And the guiding principle, of course, is always what is the mix of policy measures that brings us best towards our aim of price stability. And for that, I think the proportionality analysis is essential.
So we're very close to the hour. I'll end up with two questions which are not mutually related, but I think both are interesting. One is, in a way, a clarification question. Julian Callow is asking, so you said, you're optimistic that the ECB will get to the inflation target maybe earlier than some people think. This will have to come about on a sustainable basis associated with 3% wage growth, so your area average, or so basically, are you optimistic that your area wage growth will pick up to that kind of rate on a sustained basis? So that's, I guess, about clarification. Very different question from Yuri Batsaihan, which is about the climate change, which we largely left aside, but is also very important in the review. And this is specifically on the point on market neutrality, which you addressed in your last slide. She's asking bluntly, is market neutrality still alive? Because there is this mix of trying to correct from, lapses of neutrality from the old habits, but also to promote, good behavior, address market failures, allocate, go against allocation inefficiencies, et cetera, et cetera. So the first question is perhaps less broad than the second, but if you could give us quick replies on both, and then I'll leave the concluding words to Maury.
So it's on your first question. I mean, I tried to be a bit optimistic. Of course, in our baseline, unfortunately, we don't see that pickup in wage growth yet. But I think there, as I said before, I think there is an upside chance that this could actually happen. But so I don't remember who asked the question, but of course it depends very much on what is going to happen to wage growth. And at the moment, unfortunately, we are not yet seeing that. On the climate change, I mean, as you probably know, I've given quite a few speeches on this issue of market neutrality. So market neutrality is not a legal principle, but it is something that was used in order to ensure that our interventions in the markets do not unduly distort prices. I mean, relative prices among different assets. And this is why it was introduced. I mean, what we have in the treaty is that our actions should favor an efficient allocation of resources. And given that in the area of climate change, we are facing very strong externalities, I think there are good reasons to argue that the market allocation is probably not favoring an efficient allocation of resources. So if we follow the market allocation, we may not do what we're required to do by the treaties. It's not very easy to find an alternative to that, but I think what is quite obvious is in which direction we have to go. How to operationalize this is still to be decided. But I mean, if we end up tilting our corporate bond purchases in the direction of less emission-intensive firms, I mean, this is in any case, I guess, the right direction, even though we may not know what the first best solution is.
Maury, is the ECB getting it right, or if not, what do they get wrong?
I worry about the you know, the strength of the tools available at the zero lower bound or near the effective lower bound, particularly in the euro context. You know, I think a broader question we should ask ourselves about both this review and the Fed review is that you know, both reviews are to some extent backward looking in the sense that they are taking into account the aftermath of the global financial crisis. The ECB report explicitly mentions climate change and wants to take that into account. I think that's important, although we can debate how much central banks can do. But we should realize that going forward, we are in an unprecedented macro environment as we recover from pandemic and lockdown, as the threats of climate change indeed intensify. And, you know, being on the west coast of the US, where we've just, you know, the temperature in Death Valley reached 130 degrees Fahrenheit a few days ago. You know, climate change is staring us in the face here. We're waiting for the fire season to start. And this is a global threat with huge macro consequences. And, you know, how well our monetary and fiscal frameworks can perform over the next few years, you know, that'll be a real test. But I would predict that, you know, when the ECB does its next review in 2025, we'll be talking a lot about these global threats and how they should affect monetary policy.
Many, many heartfelt thanks to Isabel Schnabel and Maurice Obstfeld for what I certainly found an extremely enlightening discussion. Thanks to both. Isabel, you're extremely busy. Maury, you're also busy, but in addition, you're on the West Coast. So this is really a privilege to have you together today. Our next session of this series will be in 2 weeks' time on July 28, where we'll be talking about banking in Africa with Eldi Ado Adwadzi of the Bank of Ghana and Amadou C of the International Monetary Fund. And in any case, wherever you are, have a great summer time, and we look forward to seeing you again in the different series of web events at the Peterson Institute. Thanks again very much to our panelists and to the audience.
And thank you very much to you, Nicolas.